On 15 June, the US Federal Reserve announced a 75 bps interest rate hike, the biggest since 1994. This step is taken in order to curb spiraling inflation, which is currently 8.6% due to rising price of oil and food. The major reason behind this is considered as the Ukraine-Russia war and the recent lockdown in China. Though the effect of this hike will not be apparent in our day-to-day life soon, it will be very impactful on the stock market. Keep watching to see how a hike in interest rate will affect the stock market. But before that, we need to understand what the hike really means. Whenever a company wants to expand or grow, they need massive amounts of funds. These funds are procured as a loan from depository banks at a particular interest rate. Also, our house mortgage or car loan is also issued through a bank. But in reality, this amount is supplied by the depository bank by borrowing it from the Federal Reserve banks, again at a particular interest rate. There are 12 Federal Reserve banks across USA and they supply money to all the other private banks and credit unions as loans. So the flow of money is from Federal Reserve banks to private banks and from private banks to companies. During this flow, interest is collected by both federal banks as well as private banks. And the interesting thing is that the interest charged by Federal Reserve Bank on the private banks is less than the interest charged by the private banks on companies. This makes sure that the private banks will earn a profit from doing this transaction. This is how our economy works. Now what happens in an inflation is that money loses its buying power. For the last decade, employment has been really good and the economy has been doing well. This means that people have more money and they purchase more things, which leads to increase in commodity prices, which in turn reduces the buying power of money and inflation soars. The US Federal Reserve has the duty of keeping inflation under control, so they start increasing interest rate. The interest rate that we are talking about here is the one on which Federal Reserve banks give loans to private banks. This makes the private banks increase the interest rate on which they provide loans to companies and individuals as mortgage. When interest rate is increased, companies have to pay more money for their loans, which decreases their profits. Citizens also have to pay more money to buy products as most of the money will go into paying loans. This again has a very negative effect on companies as their sales will decrease and so will profits. It will take about a year for all this to be visible in real life, but stock market is very different. Markets are very sensitive to this. The stock market has been crashing this entire year because of rising inflation and fear of interest rate hike. The simple relationship between interest rate and market is that when the interest rate is increased, the stock market falls down. This is because of the decrease in profits of the company as well as buying power of people, which leads to decreasing stock prices. People feel that stock ownership will not give them good returns and they look for other investments. Although the market is falling now and might fall even more in coming days, it is just a small bump in the long journey and an excellent opportunity to purchase good quality stocks at a very cheap price. Thanks a lot for watching this video. Do like and subscribe to show your support. We'll keep making more videos on earning, saving and investing money. One stop to all your money problems. See you in the next video.